Hello friends, this is CA Sandeep Neve. Welcome to my channel. Today I plan to discuss turnover ratios. One more very important set of ratios, right? So let's understand what do we mean by turnover ratios. Okay. Now remember guys, the first and foremost thing, all turnover ratios are indicators of efficiency. Okay. Now, if you have seen the earlier videos, you must have noticed that for every type of ratios that I am teaching you, I have been giving you some hint to remember. So definitely you must be looking for some kind of hints. Yes. So that's what we want to do. First discuss that and then we will proceed with the ratios. So let us talk about the hints. As I always tell you, the first and foremost thing that you should remember is the number of ratios that you have to by heart or the number of ratios that are covered in a particular type of ratios. The very first thing, total 7 ratios. Okay, friends, how many ratios? 7 ratios. Okay. Hint number 2, very important. Sales or its alike, duplicate, twin, sibling, kind of. We will understand when we discuss the ratios. Okay. Sales or its alike in the numerator. Guys, remember these hints are the ultimate one discovered by me so that you don't face the pressure of remembering the ratios. And the third hint, as usual, name of the ratio in the denominator. Guys, these are the classy hints that I have discovered by a lot of thinking that how my students should remember this. So, turnover ratios, total how many ratios? 7 ratios, correct? The first thing that what will you remember? Sales or its alike in the numerator. What is alike? I will talk about it. Name of the ratio in the denominator. Fine, people. And as we've seen, total 7 ratios, and all turnover ratios are basically what? Indicators of efficiency. At the end of this discussion, I will give you some diagrammatic presentation also that how you should actually remember all the 7 ratios. So let's first start with it. The very first ratio that we will discuss is capital employed turnover ratio. Now, I'm very sure by this time you people must have made the ratio out of it, correct? Yes, we'll follow our rules. Fine, very simple, guys, very simple. It's going to be sales or it's alike in the numerator. So right now it is sales divided by what is the name of the ratio? Capital employed turnover ratio. So name of the ratio in the denominator that gives you a hint. Okay, so it would be capital employed dash times. Now, obviously, your next question, sir, what does this ratio tell us? Very true. Yes, that inquisitiveness has to be there. What does this ratio tell us? How effectively we utilize capital employed for what? For generating sales. Still, sir, not very clear. Okay, let's take simple example and then that makes it very easy for us. Okay, so we'll talk about two companies, company A and company B. Let's say we will put all numbers in crores. Okay, big numbers. Yeah. Still, let's keep it simple, guys. Say sales of A is 100 crore, sales of B is say also 100 crore. Now what will happen? As a layman, when you observe only the amount of sales, what you would think? Sir, both companies are performing similar, sir. Sales of A is also 100 crore. Sales of B is also that of 100 crores. Now, let me disclose another information about these two companies. What I come to know is capital employed, okay, capital employed of A is 20 crores, okay, that of B is 50 crores. Now, you can convert this data into what? You can convert it into capital employed turnover ratio. Come on, guys, the formula is there on the screen. Tell me, what will be the answer for capital employed turnover ratio of A? Obviously, sir, he is generating 5 times the sales of equal to his capital employed. What about B? B is also generating sales of 100 crore only, but for doing that, he has to use a capital employed of 50. So his sales is only 2 times of the capital employed. Precisely. And now I know you're very sure and confident that which company is better, people. Company A is better, sir. Why? Because it has a higher capital employed turnover ratio. Within the capital of 20 crore, this company is managing to generate a sales of 100 crore. So it is able to generate sales equal to how many times of the capital employed? 5 times. Company B is also generating same amount of sales, but it is taking much higher capital for that. So its capital employed turnover ratio is how many times? 2 times. People, that makes it very clear to you, right? Okay, so now hopefully you understand that these are talking about the efficiency ratios. Yes. Let's now, once the logic is clear, we can quickly cover up all the other ratios. So we talk about the second ratio, total assets turnover ratio. Okay. Have you formed the formula in your mind? Answer is yes. Hints are given to us, so we can definitely form the ratio. See, this is all helpful, right, people? So please, I request you subscribe my channel and please share with all your friends who are doing CA or maybe CS or maybe ACCA, all professional courses, wherever they have to learn financial management, wherever they have to learn ratios. Please share with all of them. Ask them to subscribe. I'm giving you the hints which will make it absolutely easier for you to remember the ratios. Yeah, please do so. Thank you. Yeah, let's continue. So, as per our tricks, what is our trick? Okay, sales are alike in the numerator, name of the ratio in the denominator. So, right now we are going with sales. So, it is sales upon what? Total assets. And guys, logic is same. How well you utilize your total assets for generating sales, right? Because asset utilization is very important. You should make the maximum out of your assets that you have bought for your business. Okay, let's talk about the third ratio. Now, I have in general compared total assets. I'm also going to compare fixed assets. So the next formula is fixed assets turnover ratio. Have you made the formula in your mind? Answer is definitely yes. I'm very sure about it. Okay. So what you'll have done, tell me, it is going to be sales upon what? Fixed asset. Absolutely right. How well we utilize our fixed assets for generating what? Sales. Correct. Now, the fourth ratio in this series is working capital turnover ratio. Come on, people. Tell me, you created formula in your mind? Answer is yes. What is our hint? Sales or its alike in the numerator and name of the formula in the denominator. Right. So we are ready with our answer. What is that? Sales upon working capital. Absolutely right. Okay, people. Tell me, these ratios aren't they connected? What do you say? They are connected, correct? See, we talk first about fixed asset turnover ratio. Okay, that how well you utilize your fixed assets for generating sales. But remember guys, can fixed assets only generate sales? No, fixed assets along with working capital, when you will utilize fixed assets and you will also make best use of your working capital, that will generate sales, isn't it? So it is equally important to see how well you are generating sales by making use of fixed assets as well as what, working capital. Yep. Now let's come to the next important part. Stock turnover ratio. Yes. Now people are saying, ah, sir, we have formulated, you have formulated, correct, guys. You must have formulated. But remember what I had told you over here. What I have told you, it is sales or it's alike in the numerator, isn't it? Yeah. And name of the ratio in the denominator. So now, guys, we all have learned since very beginning. We started our uh, journey of being a commerce student. We all have always discussed this in the balance sheet. Stock is maintained at cost. Stock is maintained at cost. So what hint I'm telling you, no, don't use sales. Stock is at cost, no, so let's make use of its cost. Okay, so cost of the goods which are sold, what we call it, simple, COGS, correct, cost of goods sold. Now but sir, what will we divide by the name of the ratio? Absolutely right, name of the ratio is stock, but I hope you know what is COGS. How we define COGS, people? Suppose it's a manufacturing concern, okay, then it will be what, opening stock plus COP, cost of production, minus what, closing stock, correct? Even if it's not a manufacturing concern, suppose it's a trading concern. So COGS, you understand the difference between manufacturing concern and trading concern. Manufacturer is the one who manufactures and sells. Trader is the one who just purchases the goods and sells, correct? So COGS over here would be opening stock plus purchases minus closing stock. So what I want you to observe is this, that whatever may be the state of the business, maybe trader, maybe manufacturer, at both places, it is opening stock as well as closing stock. So what is the simple idea, you know, guys? In the denominator, we will put what? Average stock. Now, earlier, all four ratios, you generated one logic. Okay, that how effectively we utilize capital employed for generating sales, or in total asset ratio we say how effectively we utilize our total assets for generating sales. In fixed asset turnover we say how effectively we utilize our fixed assets for generating sales. Working capital turnover we say how effectively we use our working capital for generating sales. Here we need to make a slight change in the way we understand it. See, I'm dividing cost of goods sold by opening stock and closing stock. So what is the logic behind this? What is the logic behind this? See, very important. How quickly goods are bought and sold. Guys, this is the basic health indicator of any business. As I always tell you, that see, suppose a person not feeling little well, okay, he's little unwell, he goes to the doctor. Do you really think that doctor immediately puts the patient in the ambulance, takes him to MRI center, CT scan center, perform big tests? No. First and foremost thing, what will he do? He'll check his pulse. Okay, working. He'll check his heartbeats. Okay, working. Good. Little things, basic things. He'll ask you to open your mouth, or check your eyes or something like that. Basic test. Guys, jokes apart, this also is a basic test of the business's health. How quickly goods are bought and how quickly goods are sold. Understand? If you quickly buy and quickly sell, if you quickly buy and quickly sell, what will happen? Your in general levels of stock, may it be opening, may it be closing. In general, your levels of stock would be less. Got it? You'll always be selling fresh goods. You'll be always selling what? Fresh goods. Your levels of stock would be less. if your levels of stock of less, we understand basic mathematics. If the denominator of any number, any numerator, any ratio is smaller, the answer of the ratio is bigger. So what will happen over here if we quickly buy and quickly sell? So what will happen? Let's understand. High stock turnover ratio. How high stock turnover ratio would mean what? Quick purchases, quick sales, right? And minimum, or let's say optimum inventory. See, people in any business, no, wherever there is quick sale, quick purchase, quick sale, we prefer to go to that kind of business. See, you will also justify. Suppose you want to visit a restaurant. Okay, you go to the place where there are a lot of restaurants. You are new to the place. You just take a look around and you realize that in one of the restaurant nobody is going. It's all lying empty. And in the other restaurant there are people. You know your natural choice. You'll prefer to go to that place where there are people. You may wait a little because you know that the empty restaurant means what? Maybe nobody is buying goods from there, nobody is availing their services. So what may happen? The food may be stale, the food may be cold, the food may not be that tasty. So you prefer to go wherever there is a rush. So what happens in such hotels? Goods are in any such businesses, goods are bought quickly and sold quickly. Optimum inventory is maintained. So stock turnover ratio is an indicator of the basic health of the business. It's very, very, very important ratio. Let's talk about the next ratio, that is debtors turnover ratio. Okay, let us understand the meaning of this. Once again, let's keep our logic intact. Okay, sales in the numerator and the name of the ratio in the denominator. Yeah, now I'm dealing with credit sales, no, debtors, no. So I'll specify that I'll write over here what? Credit sales, and I will divide it by average debtors. And at times, you know what? Debtors get converted into what? Bills receivable. Yes, that's why I'll also consider average bill receivable. Again, dash times. Now, what this ratio is going to show us? Okay, see how quickly goods are sold and dues are recovered from debtors. What's it, guys? If we do credit sales, we should be fast in recovery. No, working capital management. Money comes basically from whom? Money comes basically from the debtors. In any business, the most important operating revenue is sales. So you are doing a lot of credit sales. So what should happen? You should quickly get your money back. That is important, isn't it? Okay. So now let's understand. I'll place an example in front of you, as we did in the last ratio. Let's say there are two companies, A and B. Both have a credit sale of 24 crores. Okay, sir, both are at the same level. But later on, you checked and you got to know that average debtors, okay, average debtors of A are say 6 crores. Average debtors of A are how much? 6 crores, and that of B are only 2 crores. Now you'll go with the formula. Yeah, already devised in your mind. Okay. So debtor turnover ratio over here would be 4 times, right, people? And over here it would be 12 times. What does it mean? See, let me explain you this 4 times. You sell, you recover the money, one round. You sell, you recover the money, second round. Third round, fourth round. How many rounds are happening in case of company A? 4 rounds. Guys, we know number of months are 12 in a year. So can you tell me how much time is required for recovering the money? In 12 months, you are taking 4 rounds. So how much is the average collection period? Did you get it? What I asked? You are making 4 rounds in the full year. 12 months, 4 rounds. So for one round, how much time? 3 months? Yes. Okay. So the company A is collecting the debtors in how many months? 3 months. Okay, let's write the formula. So for this, we did what? 12 divided by DTR, debtors turnover ratio. Let's make formula for everything. Logic is always there, but at the end of the day, we should know the formula also. Now, what will be your answer over here? He is making 12 rounds of sale in 12 months. So how much is the time required for collection of money from the debtors? Just 1 month. So now you tell me, guys, what is better? 3 months is better or 1 month is better? But naturally, sir, 1 month is better. No, because we should quickly recover money from our debtors. So this is better. So what will you conclude? What will be your conclusion for DTR? What you will prefer? Lower you will prefer or higher you will prefer? Very simple, sir. If DTR is higher, then only we will collect the money fast. No. So what we will say for DTR? Higher the better. It means quick recovery of the money from the customers. Okay. Now, as we have done debtors turnover ratio, let's do creditors turnover ratio. Okay. Let's keep that thing in mind. Sales or it's alike, no, guys. So sales won't work over here. We are talking about creditors, no. So what has to come? Yes, smart people have already devised that in their mind. Credit purchases divided by what? Average creditors plus average. Yeah, creditors get converted into what? Bills payable. Correct. So here we'll write average bills payable. Again, same dash times. What does it show, guys? What does it show? How quickly you buy the goods and how quickly you make the payment. Now it has various interpretation. It has various interpretations. Listen to me carefully. See, you buy quickly and you make the payment quickly. It brings you goodwill in the market. Yeah, one important thing. Suppliers respect you. The day you need actual credit, that time you may get more credit. Okay. Sometimes what happens, your creditor offers you 3 months and you are a finance manager, you are very smart. You tell him, sir, you are offering me 3 months. Come on, I'll pay you in 1 month. I'll pay 2 months before your due date. Will you offer me any discount? That is also possible. So it depends from case to case. Okay. But in general, what creditors turnover ratio means how quickly you purchase and how quickly you make payment. Remember, guys, timely payment always generates goodwill for the buyer, for your company in the minds of supplier. And even though each supplier are they are a competitor of each other, still generally it's in the market, everybody knows that what you are doing as a buyer. So yeah, if you are a very regular payment maker, what happens, you have a very positive image in the market. So it's very important. Done, guys. All 7 ratios done. Ah, sir, but you told you will be giving some hint. Yes, I'm giving you some virtual hint. Okay. See how I will ask you to remember. See, if we try to summarize few things in the form of a pictorial data or something, no, it becomes very easy for us to remember. So that's what we will try to do. Let's say this is our balance sheet. Okay. Here we have equity. Here we'll have debt. Right, people? Here we'll have current liabilities. Here we'll have fixed assets. Then we will have investments. And here we will have current assets. Now see what hint I'm giving you. Okay. We all know equity plus debt is what, guys? Equity plus debt is what? Capital employed. Correct, people? Yes. So this itself becomes your first ratio. Huh. That's how we have to remember. Equity plus debt is what? Capital employed. Okay, so you can literally visualize. Okay, the whole of the balance sheet. This side is equity plus debt, that is capital employed. That's my first ratio. Capital employed turnover ratio. Okay. Now, with that capital employed, what do we do, guys? We invest in our business, we buy assets. So, fixed assets plus investments plus current asset is nothing but what? Total assets. Yes. Okay. So, that is our second ratio. Remember this capital employed turnover ratio. Then what? Total asset turnover ratio. See, in this balance sheet only, I'll give you all the hints. Then, in total assets, one of the most important asset is what? Fixed asset. Yeah, that makes our third ratio, fixed asset turnover ratio. Yes, but then what we always say, Fixed assets, no sir, cannot work on their own. Fixed asset cannot work on their own unless we make use of what? Unless we make use of working capital. See, we have to generate some hints now to remember. So that's the idea. So current asset minus current liabilities is what, guys? Working capital. So that makes my fourth ratio, working capital turnover ratio. Now you tell me, working capital always comprises of some current assets and some current liabilities. In any business, no? In current assets, no? Always, I will have stock and I'll have debtors. Generalization. Okay. So this is my fifth ratio, stock turnover ratio. This is my sixth ratio, debtors turnover ratio. And in any business, no guys, in current liabilities, we will always have what? Will always have creditors. So that makes my seventh ratio. Understood? See, this is this is a visualization we try to do so that we remember the things so that it becomes easier for us, right? So total how many ratios? Turnover ratios, tell me. Total seven ratios. The first one is what? Capital employed turnover ratio. Second one is what? Total asset turnover ratio. Third one is what? Fixed asset turnover ratio. Fourth one is what? Working capital turnover ratio. Fifth, stock turnover ratio. Sixth, debtors turnover ratio. Seventh, creditors turnover ratio. I hope, guys, you find this very much important, very much interesting, and I have made it easiest possible. See the hints that I have given you over here. They are going to play a great role in remembering all this, right? So, what are our hints? Total seven ratios. Second hint, sales or its alike in the numerator. And the third hint is what? Name of the ratio will come in the denominator. If you have liked this ideas, right? I request you to subscribe to my channel and please let's share the knowledge and let's grow together. So please share with all your friends who are doing some professional courses like CA, CS, SCCA. For all those people who are willing to learn some concepts of financial management, please share with them. Thank you so much, guys. I hope you liked it.